The information provided by Michael Beebe and this channel is for educational and informational purposes only. Michael Beebe is not a licensed financial advisor or investment professional. The content presented does not constitute financial, investment, or legal advice. Before making any financial decisions, it is strongly recommended that you seek advice from a qualified financial advisor or investment professional who can provide personalized guidance based on your individual circumstances. Investing in cryptocurrencies and other financial instruments involves significant risk and may not be suitable for all investors. Past performance is not indicative of future results, and there is no guarantee that any investment strategy will achieve its objectives. Michael Beebe and this channel are not responsible for any losses or damages arising from the use of this information or from any decisions made based on the content provided. Always conduct your own research and consider your financial situation, risk tolerance, and investment goals before making any investment decisions.
Part 1, Introduction.
In a world where every transaction we make involves paper bills or digital numbers on a screen, have you ever wondered what gives our money its value? This is what we call fiat currency, money that has value because governments say it does, not because it's backed by something tangible like gold. But what if I told you that using this kind of money comes with hidden costs? Costs that affect not just the economy, but also your personal finances? In this video, we're going to explore the less obvious impacts of fiat currency on both economies and individuals.
Part 2, What is fiat currency?
Let's take a closer look at what fiat currency really is. At its core, fiat currency is simply money that holds value because a government says it does. Unlike earlier forms of currency that were backed by physical commodities like gold or silver, fiat money doesn't have intrinsic value. It's essentially a promise, supported by the authority of the government that issues it. To understand how we got here, let's rewind a bit. There was a time when paper money was directly tied to something tangible, like gold. This was known as the gold standard. Under this system, every dollar, pound, or yen in circulation could be exchanged for a specific amount of gold held by the government. This gave people confidence that their money was worth something real, something physical. However, as economies grew more complex and global trade expanded, the limitations of the gold standard became clear. There simply wasn't enough gold to support the growing demand for money. So, in the 20th century, many countries, including the United States, began to move away from the gold standard. Instead of being backed by a physical commodity, their currencies became fiat money, valued purely by government decree. Today, fiat currency is the norm across the world. Whether you're spending US dollars, euros, or Japanese yen, you're using fiat money. These currencies are accepted and trusted not because they're linked to a tangible asset, but because people have faith that their governments will maintain their value. This shift has allowed for greater flexibility in managing economies, but it also comes with its own set of challenges and hidden costs, which we'll dive into further.
Part 3, Inflation, the silent tax.
One of the most significant yet often overlooked aspects of fiat currency is its vulnerability to inflation. Inflation is like a silent tax, steadily eroding the purchasing power of your money over time. But what exactly is inflation, and why does it happen? Inflation occurs when the general level of prices for goods and services rises, meaning that each unit of currency buys fewer things than it did before. In simple terms, as prices go up, the value of your money goes down. This means that the same amount of money will get you less tomorrow than it does today, effectively shrinking your purchasing power. But why does inflation happen in the first place? The answer lies largely in how fiat currency is managed. Central banks, like the Federal Reserve in the United States, have the power to control the supply of money in an economy. They do this by printing more money or by adjusting interest rates. When more money is introduced into circulation, or when interest rates are kept low, people and businesses tend to borrow and spend more. This increased demand can lead to higher prices, which is inflation in action. For example, let's look at Germany in the early 1920s. After World War I, the German government began printing large amounts of money to pay for war reparations and to stimulate the economy. But this rapid increase in the money supply led to hyperinflation, where prices spiraled out of control. At the height of this crisis, people were carrying wheelbarrows full of banknotes just to buy a loaf of bread. The value of their currency had plummeted to the point where it was practically worthless. While hyperinflation is an extreme case, even moderate inflation can have a noticeable impact on your savings. Consider the United States in the 1970s. During this decade, the country experienced high inflation rates, sometimes reaching double digits. As prices soared, the purchasing power of people's savings diminished rapidly. Money that was set aside for retirement or future expenses lost value, forcing many to rethink their financial strategies. Today, inflation continues to be a concern for many countries. Central banks constantly monitor inflation and adjust their policies to keep it in check, aiming for a stable, low rate of inflation that encourages spending without devaluing the currency too much. But even in a well-managed economy, the effects of inflation are always present. Over time, it can quietly eat away at the value of your money, making it harder to save for the future or maintain your standard of living. In a world where fiat currency reigns supreme, understanding inflation is crucial. It's a hidden cost that can have profound effects on both economies and individual lives. As we continue to explore the impacts of fiat currency, keep in mind that inflation is just one of the many ways in which the money in your pocket might not be as stable as it seems.
Part 4, the cost of debt.
Debt is another significant, often hidden cost of living in a world dominated by fiat currency. Unlike money that is backed by tangible assets, fiat currency systems inherently encourage the creation of debt, both on a personal level and at the national scale. But why does this happen? The answer lies in the nature of fiat currency and how it's managed by governments and central banks. Because fiat money isn't tied to a physical commodity, it can be created relatively easily. This flexibility allows central banks to manipulate the money supply to stimulate economic activity, often by lowering interest rates. When interest rates are low, borrowing becomes more attractive. Suddenly, taking out loans for everything from homes to cars to education seems like a smart, affordable option. This ease of access to credit is a double-edged sword. On the one hand, it fuels economic growth by enabling consumers and businesses to spend and invest. But on the other hand, it leads to a culture of debt, where borrowing becomes the norm rather than the exception. For individuals, this can mean taking on mortgages, credit card debt, and student loans that may seem manageable at first but can quickly spiral out of control, especially if interest rates rise or income levels fall. And it's not just individuals who fall into this trap. Governments also take advantage of fiat currency systems to finance spending through borrowing. National debt, often measured in trillions of dollars, has become a standard feature of modern economies. Governments borrow money to fund everything from infrastructure projects to social programs to military operations, all with the expectation that future economic growth will make it easier to pay off these debts. But there's a catch. As national debt levels rise, so too does the cost of servicing that debt, meaning the interest payments that must be made each year just to keep up with what's owed. This creates a growing financial burden on the government's budget. In the long term, high levels of national debt can lead to higher taxes, reduced public services, or even austerity measures as governments struggle to balance their books. The debt that seemed so manageable at first can quickly become a significant drag on the economy, stifling growth and innovation. For individuals, the rising levels of debt encouraged by fiat currency systems can have serious consequences. When debt becomes too burdensome, it can lead to financial instability, personal stress, and even bankruptcy. What's more, the easy availability of credit can create a false sense of security, where people feel wealthier than they actually are because they can buy things on credit. But this perceived wealth is an illusion. The more debt people take on, the more they're tied to the banks and financial institutions that hold that debt, and the less financial freedom they actually have. Ultimately, the cost of debt is one of the most significant, yet least talked about, aspects of living in a fiat currency world. It's a cost that isn't immediately visible but becomes painfully apparent when the bills come due, whether that's in the form of monthly payments for individuals or massive interest obligations for governments. As we continue to examine the hidden costs of fiat currency, it's essential to recognize how debt can shape our financial futures in ways we might not expect.
Part 5, Wealth Inequality.
Wealth inequality is one of the most profound and troubling consequences of the modern fiat currency system. While inflation and monetary policy can influence the entire economy, their effects are not felt equally across all segments of society. In fact, these forces often serve to widen the gap between the wealthy and everyone else. To understand how this happens, we need to look at who benefits from inflation and who doesn't. Inflation, as we've discussed, erodes the purchasing power of money. For most people, especially those who earn wages or save their money in traditional accounts, this means that the value of their income and savings diminishes over time. The money they earn buys less and less, making it harder to keep up with the rising cost of living. However, not everyone is equally affected by inflation. Those who hold assets like real estate, stocks, or commodities often see the value of their investments rise with inflation. When the prices of homes, stocks, or other assets increase, the owners of these assets grow wealthier, even as the purchasing power of ordinary wage earners declines. This creates a significant disparity. The rich, who own most of the assets, get richer, while the middle class and the poor, who rely on wages, find it increasingly difficult to build wealth. Monetary policy plays a crucial role in this dynamic. When central banks lower interest rates to stimulate the economy, it makes borrowing cheaper. This can lead to a boom in asset prices as more people take out loans to buy homes, invest in the stock market, or finance other large purchases. Those who already own assets see their wealth increase, while those who don't are often priced out of the market. The result is a growing divide between those who have wealth and those who do not. Let's look at some examples to illustrate this point. In the United States, the gap between the richest and poorest households has widened significantly over the past few decades. According to recent studies, the wealthiest 10% of Americans now control nearly 70% of the country's wealth. Meanwhile, the bottom 50% of households own just 1%. This stark disparity has been fueled in part by rising asset prices, driven by low interest rates and expansive monetary policies. And it's not just the United States. Similar trends can be observed in other countries as well. In the United Kingdom, for example, property values have soared in recent years, making it increasingly difficult for younger generations to afford homes. At the same time, those who already owned property have seen their wealth multiply, further entrenching the divide between the haves and the have-nots. This growing wealth gap is more than just a matter of economic statistics, it has real consequences for society. As the rich become richer and the poor struggle to get by, social tensions can rise, leading to increased political instability and a sense of injustice among those who feel left behind. The system that is supposed to provide equal opportunities for all instead perpetuates a cycle of inequality, where the benefits of economic growth are concentrated in the hands of a few. In a world where fiat currency and monetary policy are driving these disparities, it's essential to recognize the role they play in shaping our economic landscape. The hidden costs of fiat currency are not just about inflation or debt, they're about the very fabric of our societies and the growing chasm between different classes. As we reflect on these issues, it's clear that the impact of fiat currency goes far beyond what we see on the surface, affecting every aspect of our economic and social lives.
Part 6, The Erosion of Savings.
One of the most personal and painful consequences of living in a fiat currency system is the erosion of savings. Over time, the value of money tends to decrease due to inflation, and this gradual loss can significantly impact individuals who are trying to build and preserve their wealth. When you save money in a traditional savings account, the amount you put away today may not hold the same value in the future. As inflation erodes the purchasing power of your money, the real value of your savings diminishes. This means that the money you've carefully set aside for future needs, whether it's for retirement, a rainy day fund, or a major purchase, will buy less and less as time goes on. The longer you wait to spend it, the more it loses its value. But inflation isn't the only factor at play. Low or even negative interest rates, which are often implemented by central banks to stimulate economic activity, further erode the incentive to save. When interest rates are low, the returns on savings accounts and fixed income investments are minimal. In some cases, interest rates can be so low that they don't keep pace with inflation, effectively leading to a negative real return on savings. This means that instead of growing, your savings are actually losing value. For many people, this situation creates a dilemma. With traditional savings accounts offering negligible returns and inflation steadily reducing the value of their money, individuals are pushed to seek out riskier investments in hopes of achieving higher returns. The quest to preserve the value of their savings can lead them to explore more volatile assets, such as stocks, real estate, or even speculative investments like cryptocurrencies. While these investments have the potential to offer higher returns, they also come with greater risks. The pursuit of higher returns can expose individuals to market fluctuations and financial losses, potentially undermining their long-term financial goals. Consider the example of retirees who have spent decades saving for their golden years. With traditional savings accounts providing poor returns and inflation reducing the value of their nest egg, many are forced to invest in stocks or real estate to try to keep their savings intact. However, the volatility of these markets can create uncertainty and stress, as the value of their investments can fluctuate dramatically. Another example can be seen in the rise of investment vehicles like high-yield bonds or peer-to-peer lending platforms. These options may offer higher returns compared to traditional savings accounts, but they come with increased risk. Investors seeking to outpace inflation or achieve higher yields may find themselves navigating complex and unpredictable financial landscapes. The erosion of savings in a fiat currency system highlights a fundamental challenge. As the value of money decreases and interest rates remain low, individuals are left with fewer safe options to preserve their wealth. The drive to protect their savings can lead them into riskier financial territories, where the potential for loss is higher. This ongoing struggle underscores the broader impacts of fiat currency on personal financial security and the constant balancing act between risk and reward. As we continue to explore the implications of fiat currency, it becomes clear that the erosion of savings is not just an abstract economic issue. It's a deeply personal challenge that affects the financial stability and peace of mind of countless individuals. Understanding these dynamics is crucial for navigating the complex world of modern finance and making informed decisions about preserving and growing wealth.
Part 7: Loss of monetary sovereignty.
As we delve into the impacts of fiat currency, one of the more complex issues to consider is the loss of monetary sovereignty. Reliance on fiat currency doesn't just affect individuals and economies in the abstract, it can significantly influence a nation's control over its own economic policies and, by extension, its sovereignty. When a country adopts a fiat currency system, its economy becomes closely tied to the decisions made by its central bank. Central banks are responsible for managing the money supply, setting interest rates, and implementing policies to guide economic activity. While these measures are intended to stabilize and stimulate the economy, they also mean that a nation's economic fate is often subject to the decisions of a central authority. This can limit a country's ability to pursue its own monetary policies, particularly if those policies conflict with the broader objectives set by the central bank. For smaller or developing nations, the consequences of losing control over their monetary policy can be even more pronounced. These countries often have less economic leverage and fewer resources to counteract the effects of central bank decisions or external economic pressures. When a central bank's policies are not aligned with the needs of a smaller nation, it can lead to economic instability, higher inflation, or reduced growth prospects. The lack of monetary autonomy can make it challenging for these nations to address local economic issues effectively, potentially hindering their development and progress. Moreover, the influence of fiat currency extends beyond national borders. Geopolitical factors and international financial markets can also play a significant role in shaping the value and stability of a nation's currency. For instance, global economic conditions, trade relations, and geopolitical tensions can all affect a country's currency value, even if that country has little control over these external factors. Countries with fiat currencies can find themselves at the mercy of global financial trends and political dynamics, which can lead to fluctuations in their currency's value and further complicate their economic situation. Take, for example, the impact of international sanctions. When countries face sanctions from major global powers, their access to international markets and financial systems can be restricted. This can lead to significant economic hardship, as these nations may struggle to maintain currency stability and manage inflation in the face of external pressures. The interplay between national policies and global influences can create a precarious situation where even well-intentioned domestic policies are undermined by factors beyond a nation's control. Another illustration is the effect of global economic crises. During financial downturns or crises, nations with fiat currencies may experience severe currency devaluations or economic disruptions as global investors move their assets to safer havens. These fluctuations can be particularly challenging for smaller or developing countries that lack the financial buffers or policy tools to counteract such impacts. In essence, the reliance on fiat currency can erode national sovereignty by constraining a country's ability to independently manage its economic policies and navigate external pressures. This loss of control can have far-reaching consequences, affecting everything from inflation rates to economic stability. As we explore the broader implications of fiat currency, it's crucial to recognize how the intersection of domestic policies and international factors can shape a nation's economic landscape and influence its path toward growth and stability.
Part 8. Environmental and social costs.
As we examine the consequences of fiat currency, it's important to consider not only the economic impacts but also the environmental and social costs that come with it. The production and management of fiat currency can have significant effects on our planet and society, often hidden from view but nonetheless impactful. Starting with the environmental impact, the production of fiat currency is not as benign as one might think. For physical currency, whether it's paper money or coins, the process requires substantial resources. Printing banknotes involves large amounts of energy and materials, including paper, ink, and specialized coatings. Minting coins, particularly those made from metals like copper, nickel, or zinc, demands mining, refining, and manufacturing processes that are resource-intensive and environmentally taxing. Moreover, the rise of digital transactions, while seemingly more environmentally friendly at first glance, also comes with its own set of environmental costs. The infrastructure needed to support digital banking and transactions, including data centers, server farms, and the extensive networks of computers and communication systems, requires significant amounts of electricity. Data centers, for instance, consume enormous amounts of energy to power servers and maintain cooling systems. This energy consumption contributes to the broader issue of carbon emissions, particularly if the electricity used comes from non-renewable sources. Turning to the social costs, the effects of fiat currency on inflation and economic instability can be profound. Inflation, as we've discussed, erodes purchasing power and can lead to a higher cost of living. When people struggle to afford basic necessities due to rising prices, it can result in social unrest. The frustration and anxiety caused by financial insecurity can lead to protests, strikes, and increased social tensions. In extreme cases, persistent economic instability can destabilize governments and lead to broader societal upheaval. The social impact extends beyond immediate financial pressures. Long-term economic instability can reduce overall quality of life, affecting everything from access to healthcare and education to employment opportunities. When inflation and economic uncertainty become a persistent problem, they can undermine public trust in institutions and erode the social fabric of communities. Additionally, the pursuit of economic growth under a fiat currency system can sometimes lead to unsustainable practices. The drive for continuous growth often leads to increased resource extraction, environmental degradation, and a focus on short-term gains at the expense of long-term sustainability. This can manifest in various forms, such as overexploitation of natural resources, pollution, and habitat destruction. The focus on immediate economic performance may overshadow the need for environmental stewardship and responsible resource management. Consider the impact of rapid urban expansion and infrastructure development driven by economic growth. While these projects may boost the economy in the short term, they often come with environmental costs such as deforestation, loss of biodiversity, and increased carbon emissions. Moreover, communities affected by such developments may face displacement and loss of livelihoods, exacerbating social inequalities and contributing to further unrest. In summary, the environmental and social costs associated with fiat currency systems are significant and multifaceted. From the resources used in currency production to the broader implications of inflation and economic instability, these costs extend beyond the immediate financial realm. Understanding these impacts is crucial for developing more sustainable and equitable economic systems that take into account both the well-being of people and the health of our planet.
Part 9, Potential Solutions and Alternatives.
As we reach the end of our exploration into the hidden costs of fiat currency, it's worth considering potential solutions and alternatives that could address some of the challenges we've discussed. While fiat currency systems have their drawbacks, there are various options and reforms that could potentially offer improvements or mitigate some of the negative impacts. One prominent alternative to fiat currency is cryptocurrencies. Unlike traditional fiat currencies, cryptocurrencies are digital assets that rely on blockchain technology for their security and transaction verification. Cryptocurrencies like Bitcoin and Ethereum operate outside the control of central banks and governments, which means they are not subject to the same inflationary pressures. In theory, this could offer a more stable store of value and reduce some of the issues associated with fiat currency inflation. However, cryptocurrencies also come with their own set of challenges. The volatility of cryptocurrency prices can be extreme, making them a risky investment and less stable as a medium of exchange. Additionally, the energy consumption required for cryptocurrency mining, particularly for proof-of-work systems like Bitcoin, has raised significant environmental concerns. While cryptocurrencies can provide an alternative to fiat money, they are not without their own costs and complexities. Another alternative is using gold or other commodity-backed currencies. Gold has historically been valued as a store of wealth and has been used as money for centuries. Commodity-backed currencies, which are pegged to the value of a physical commodity like gold, can offer a more stable value compared to fiat currencies. The idea is that by tying currency to a tangible asset, you can reduce the risk of inflation and maintain a more stable purchasing power. However, commodity-backed currencies also have limitations. They can be inflexible, as the money supply is constrained by the availability of the underlying commodity. This can make it difficult to respond to economic changes or crises. Additionally, the process of converting currencies into physical commodities and managing the reserves required can be complex and costly. In addition to exploring alternative currencies, there are also potential reforms and policy changes within the fiat system itself that could help mitigate some of its negative impacts. For instance, adopting more stringent monetary policies and transparency measures can help reduce inflation and improve financial stability. Implementing frameworks for better management of national debt and exploring balanced approaches to fiscal policy can also contribute to a more stable economic environment. Another potential reform is the introduction of digital central bank currencies, CBDCs. CBDCs are digital forms of a country's fiat money issued and regulated by the central bank. They could offer benefits such as more efficient transactions, reduced costs of currency production, and greater control over monetary policy. By addressing some of the inefficiencies and costs associated with physical money, CBDCs could potentially offer a modern solution to some of the issues with traditional fiat currency. Ultimately, while alternatives and reforms offer various potential benefits, they each come with their own set of trade-offs. Cryptocurrencies and commodity-backed currencies present unique opportunities, but also face significant challenges. Reforms within the fiat system could improve its functionality and stability, but they may not fully resolve all underlying issues. The key lies in carefully weighing these options and considering how best to balance the benefits and drawbacks in the pursuit of a more stable and equitable economic system. As we continue to navigate the complexities of our financial world, exploring and understanding these alternatives and reforms can help us better address the hidden costs associated with fiat currency and work towards a more sustainable and resilient economic future.
Part 10, Conclusion.
As we wrap up our exploration into the hidden costs of fiat currency, let's recap the key points we've covered. We began by defining fiat currency as money that derives its value from government endorsement rather than being backed by physical commodities like gold or silver. This system, while convenient and widely used, carries with it a range of hidden costs that are often less visible but deeply impactful. We discussed how inflation erodes the purchasing power of money over time, affecting both personal savings and broader economic stability. We explored how central banks manage inflation through monetary policies, and how these policies can sometimes lead to economic challenges, including the increased burden of national debt. The reliance on fiat currency systems can encourage debt accumulation, impacting both personal finances and governmental economic health. The conversation also touched on how inflation and monetary policies can exacerbate wealth inequality, benefiting asset holders while wage earners and savers may struggle to keep up with rising costs. We examined the erosion of savings, as low or negative interest rates push individuals towards riskier investments in an attempt to preserve value. Additionally, we looked at the loss of monetary sovereignty, where nations become tied to the policies of central banks, potentially reducing their control over economic decisions. This can be particularly challenging for smaller or developing countries, which may find themselves vulnerable to external economic pressures and geopolitical factors. The environmental and social costs of fiat currency were also highlighted. From the resources required for physical currency production to the broader impacts of inflation on social stability and quality of life, the effects are far-reaching. Unsustainable economic practices driven by the pursuit of growth can further exacerbate these issues, leading to both environmental degradation and increased social unrest. Finally, we considered potential solutions and alternatives to fiat currency, including cryptocurrencies, gold, and commodity-backed currencies. Each of these options presents its own set of benefits and challenges, and while they offer different approaches, they do not completely eliminate the hidden costs associated with fiat systems. Reforms and policy changes within the fiat framework itself could also provide ways to address some of these issues, but they come with their own complexities. In conclusion, while fiat currency systems provide a convenient and flexible means of managing economic transactions, it's crucial to remain aware of the hidden costs they entail. Understanding these impacts can help us make more informed decisions about how we manage our money and navigate the financial world. As we move forward, consider this: how can we adapt our financial strategies to better account for the realities of a fiat-driven world? What steps can we take to mitigate these hidden costs in our own lives and communities? Reflecting on these questions can lead us to more thoughtful approaches to managing our resources and participating in the global economy.
Part 11, Subscribe.
If you found this exploration into the hidden costs of fiat currency valuable, we'd love for you to show your support. Please like, share, and subscribe to our channel. Your engagement helps us continue to bring you insightful content and explore important topics like this one. Remember, we also have a live stream called Intrusive Thoughts Live, where we dive into a variety of topics and engage with viewers in real time. It's a great opportunity to join the conversation and get involved. We'd love to hear from you, so feel free to leave a comment below. Share your thoughts on fiat currency or your personal experiences with inflation. Your feedback and perspectives are invaluable and contribute to the broader discussion. For more insights into economics and personal finance, be sure to check out our related videos. They offer additional information and strategies that can help you better understand and navigate the financial landscape. Thank you for watching, and we look forward to seeing you in the next video.
Thank you so much for watching. If you enjoyed this video, make sure to check out the rest of my channel for more great content. Don't forget to like, subscribe, and hit the bell icon so you never miss an update. Your support means the world to me. See you in the next video.